Isabelle, thank you for joining me today. We're here in Park City at the Fortune Brainstorm Tech Conference. Beautiful setting. How you doing?
Good, thank you.
Excellent. So I want to talk to you a little bit today about the SPAC market. You've been a principal, very entrepreneurial. You've helped raise capital. You've worked on a number of deals. So I think you're my resident expert on this. So let me set the stage. 2021, we saw 300 and some SPACs raise $160 billion. And year to date, we're at about 17 SPACs for under $2 billion. So there's been a complete halt of new issuance. I'm just curious from your perspective, do you see a renaissance of the SPAC IPO market coming?
It's funny you mentioned that number of 300 because that corresponds to the number of SPAC deals that we have seen close in the last year relative to about a dozen IPOs. It is a solution that continues to exist for companies, an alternative to IPOs that provides a number of advantages. And we've seen a lower number of SPACs as some liquidate and are now out of the market. So we continue to see the best stay around.
So what time frame do you think for further IPOs? You know, I look at the landscape and I see, most of those previous SPACs having been washed out of the market. I think, we're sitting here in mid-July, and if you fast forward to August or September, barring new issuance, the number of SPACs outstanding is probably in the 30s or 40s and very few. So I see a lot of opportunity. Do you kind of agree in that thinking?
Absolutely. I think there's room for more qualified sponsors who can actually add value to the companies that they take public, right? And that's been a big issue in 2021 when we saw a number of SPAC sponsors that didn't have either the network or the resources, and in many cases that were not full-time. We really position ourselves as service providers. That is what we are to the companies that we take public.
Right.
And having full-time management teams is key to the success of the transaction.
So you mentioned 300 deals have closed. Clearly one of the big challenges over the last year has been the closing of transactions. And I think there's a number of factors you can point to that have complicated the process. Valuation, as the markets fell in 2022 and bargains that were struck for SPACs in June of 2022 didn't look terribly attractive in February of 23, right, as valuation fell. So clearly valuations, redemptions have been high. That's been a complicator. Do you see that improving, or is there a way to improve on the pace of closings or the percentage of closings that might re-inspire new SPAC sponsors?
So we need to reassess what a successful transaction means, and what it means is a successful stock price, performance, value creation for all stakeholders. And so what we've seen in SPACs is, to your point, valuations that were high in line with market, right? That came down, but they were high relative to where they are now. So of course, those valuations and market caps went down. Redemptions are high and will continue to be high because the investors in the IPOs of SPACs are the same investors that we offer converts to. So why would they stay at $10 a share when they have complete downside protection by investing in a convert? So those redemptions are going to continue to be high. And when we work with companies, we assume 100% redemptions and solve for what their cash needs are. If we're not able to do that, we just don't take them public. So we only work with companies where we're able to satisfy their cash needs.
So you bring up redemptions. So redemptions have been running this year in the 80 to 90% range. Obviously, that creates the scenario where when the SPAC and the operating company merge, the anticipated cash that comes to the balance sheet is a lot less than was hoped for. So how do we solve for that capital problem?
We still, again, assume 100% redemptions and solve for the company's cash needs to make sure they have sufficient capital to operate for the following 2-3 years at a minimum if they're not profitable. That said, we seek to work with companies that are close enough to profitability, if not already profitable. We have been at the forefront of structuring financial products that answer those cash needs. And those can be a mixture of debt products, for example, that are non-dilutive to the company, as well as structured equity products. To do that, we partner with typically hedge funds that act as counterparties to products such as ELOCs that can provide a large pool of capital, about $100 million, that provides the investor, one, downside protection, and two, a guaranteed return. Those products can, on occasion, have a negative impact on the stock price because the counterparty will turn around and sell the stock.
Yep.
So they get paid back in shares and go and sell the stock. I think a lot of founders did not understand that product, and we believe there's a better way to do this, a fair way to structure equity products for founders to answer both the cash needs and investors' need for protection. on the downside. And for that, we are structuring a fund that can provide capital to companies before we take them public. It takes a year to go public through a SPAC or an IPO. The SPAC process is much less work for the founders. The IPO process is a very intensive 1-year-long process during which the founder is on the road engaging with investors. But the companies that need cash immediately, we're able to answer those needs with our fund and invest in the continuum of products that are needed to make for a successful transaction and supports the stock price. Importantly, so that includes private products, credit, and public structured equity products that happen after the transaction closes. Importantly, the incentives tend to be misaligned the way we see it now, with different service providers, different capital providers that each have their own goal. We, in our fund, align incentives by being the sole capital provider in the transaction with nothing in mind but the stock price.
That was great talking to you. Thank you very much.
Thank you.